U.S. officials say the Strait of Hormuz is open to all vessels seeking safe transit. That is despite Iran saying that waterway is now closed.
Here to discuss what that means for key goods and commodities as they try to get through that strait is Bloomberg Intelligence senior commodities strategist Mike McGlone. All right, Mike, one country says the strait is open, one country says the strait is closed. What are the markets saying?
Well, the market is kind of believing the U.S. and kind of pushing back in the rhetoric from Iran. And even if it does, they do close it up significantly. We've proved that what the sentiment was is 20% of global supply turned out to be 10% or less because of invention and necessity. People found ways around through pipelines. The key theme for me is what will it take to get crude oil to stay above $80 a barrel? $80 a barrel was significant because it was last year's high versus its normal propensity to head towards its cost of production, the world's largest producer, which is around $55 a barrel in the U.S. So I think it's more likely to head lower. But the key thing that's happening in crude oil is we have a significant bifurcation between the actual price of crude oil, which I think is going to head lower, and the price of gasoline and diesel, what we call distillates at the pump. And that word we use for that is the crack spread, the spread between what actually is refined from crude and what the underlying foundation of crude is. And the crack spreads have reached the highest almost ever, but very similar to what we got in 2022, which marked a peak in price, and then everything rolled over back lower.
Christina, who doesn't like the crack spread right now is one President Donald Trump. He's still furious about the price of gas relative to the price of oil. A very basic question for you here, Mike. Look, oil is so much less than it was at its wartime peak, and I'm curious why that's the case. It seems to me that the level of confusion and uncertainty may have subsided a little bit here, but as we pointed out, there are dueling narratives about the state of the strait. There's still a lot of uncertainty about the path forward for this war. Why then are oil prices still as low as they are relative to where they were at the start of this conflict?
Well, David, I really enjoyed pointing out some of the things I did in 2022 and the foundation of this country and Adam Smith and the high price cure and the invisible hand. And that's what we really accelerated is the price making status in crude oil shifted to the Western Hemisphere with U.S. in the middle. We used to be the largest importer. Now we're one of the largest exporters. That's what shifted. And if you include Canada, we're approaching a surplus of crude oil liquid fuel supply next year of 8 million barrels a day. And a lot of that, what happened is we just accelerated that process of more supply coming from the Western Hemisphere, from Canada down Argentina, and OPEC becoming more and more redundant. So it accelerated that process. Also, and I always look over at the latest estimates from the Department of Energy for U.S. gasoline demand. It's declining. Yet prices have spiked. So this is a classic cycle in commodities. Typically what happens in crude oil, let's just look at it, it's been in a 20-year range. We're right at the bell curve of that range, right around $71 a barrel. We just pumped up the upper end. We accelerated more supply, decreased demand. We're probably going to head towards the lower end. So by the end of the year, I'm making a call that crude oil is going to be below 50, maybe even 40. And one key thing for that is almost always bottoms when the stock market goes down a little bit. We usually get a pickup in stock market volatility for midterm election years. And it's, so that to me is a key thing to look forward to the second half of the year. And the bottom line is, what does the leader of the largest energy producer, net exporter, and someone who initiated this war in Iran need for the midterms? He needs lower energy prices. I fully expect that to happen.
I've written this down, Christina. McGlone's call, 40 to 50.
It is. He wrote it in blue highlighter, so you know it's real. I do want to ask what the role of reserves is playing in this pricing, because I've seen some very complicated charts. There seems to be a bit of a debate about how much that has been keeping the price more palatable despite these disruptions. The U.S. Strategic Petroleum Reserve is at a 20-year low, and then demand from China has really dropped off, and the thinking is that they are also drawing on reserves. What is the status of those reserves? Do you expect that to continue throughout the end of the year, or do you think this will be replaced at some point with just taking supply from where it comes?
Well, I'm glad you went there because reserves are significant. Remember, the U.S. Strategic Petroleum Reserve was started in 1974 by President Ford to cover 90 days of net imports. I just pointed out we have a surplus of exports. So we don't really need it anymore except for things like hurricanes and what just happened. And the key theme country who really needs reserves is China. What we found out, what didn't really make a lot of sense last year, is why crude oil, their demand stayed steady around 11 million barrels a day, yet their 10-year notes yields are collapsing, showing an economy that's really in deflation. We found out that China built up some of the best reserves and biggest in history, and they need to. They're a net importer. The lessons I've learned in commodities is Chinese are the best traders. Prices are up, they sell. Prices go down, they buy. And I fully expect that cycle to go lower. But the thing that we learned is China has a pretty significant surplus of reserves. And by the way, EVs in China are cheap, and it's over 60% of sales now.